Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 6, Corporate Capital Budgeting. A great source for this topic is the Benninga textbook, chapters 4 through 7. In this topic, we're going to talk about capital budgeting. Capital budgeting is the process of valuing and selecting investments to create value. NPV and IRR are the primary measures of value. In this topic, we're going to calculate the NPV and IRR of revenue-producing investments, cost reduction investments, lease versus buy decisions. We'll talk about the choice of accelerated or straight line depreciation and how that affects NPV and IRR. We'll talk about outsourcing decisions, and we'll try to modify the NPV method to handle projects of unequal lifespans. We'll also discuss when it's appropriate to use WACC as the NPV or IRR hurdle rate. Lastly, we'll discuss which measure, NPV or IRR, and a new one we're going to give you, payback period, should be used when selecting projects. So the first thing we'll talk about is the use of the discount rate. The appropriate cash flow to use to look at the attractiveness of a project are the free cash flows. The ones we focused on are free cash flows to the firm. Now, free cash flows of the firm is generally preferable because it's easier to calculate. You're not forecast to calculate, say, debt purchases and retirements and interest expense, so it's a lot easier to calculate free cash flows of the firm. If you use free cash flows of the firm, it's appropriate to use the WACC as a discount rate. However, we're going to talk about when you do not use that. So first of all, if free cash flows of the firm is used, many firms will use a discount rate equal to the WACC. However, as we're going to talk more about in the next topic, this is only appropriate if the project you're evaluating has the same risk as the firm. So for example, if a firm is looking into getting a new industry, it probably should not use its existing WACC because its existing WACC reflects the risk of its current business. Also, many projects you look at might be infrastructure projects, really not related to the core business risk, but it might be just building a new parking garage for the corporate headquarters. So it doesn't really have to do with the riskiness of the business. In that case, you could really make a claim that it should be it's a risk-free investment. We're going to have a known cash flow. And so if we have that, we could use the risk-free interest rate, say long-term treasury rate, or what firms will commonly do as a proxy for a risk-free hurdle rate or NPV discount rate, they'll use their after-tax cost of debt. So we're going to start off by calculating the NPV and IRR of a revenue-producing asset. This asset is going to be an $800 machine we're going to purchase today. It has zero salvage, nothing. It's going to be worth nothing at the end. It's going to last 8 years. Each year, at the end of the year, it's going to have sales of $1,000, cost of goods sold, SG&A, a tax rate of 40%. We're going to use 15% as our discount rate, and we're going to depreciate the CapEx over 8 years. So let's go ahead and go to our model. And we're going to go ahead and build an income statement. We got our sales. We have our cost of goods sold. We have SG&A. Now CapEx, we're going to assume we depreciate the full value of the CapEx over a straight line period of 8 years. So 800 divided by 8. So the annual depreciation expense is $100. That gives us an EBIT of 200. Taxes on 200 at 40% or 80, and gives me an EBIT after tax, or NOPAT, net operating profit after tax, of 120. But again, let's get back to free cash flows. Let's take our EBIT after tax, and we're going to add back our depreciation. Let's assume there's no additional CapEx after the initial period, and there's no working capital requirements for this business. So this business is going to cost us $800 today. It's going to generate cash flows of $220. I'm going to anchor that every year for the next 8 years. And we can calculate the NPV of this investment just by saying NPV, put in a discount rate, put in the future cash flows, and add back the first cash flow today. So we get an NPV of 187. And we can do an IRR, putting in all the cash flows, of 2184. So it looks like, is the NPV greater than 0? Yes, so we're going to do the project. In other words, is the IRR greater than the hurdle rate? Yes. 21% is greater than 15%. So again, what NPV means is if we do this project and we fund it the entire $800 investment at 15%, we will make enough money to pay off our capital providers and have some money left over. The NPV is the present value of the extra cash if we paid back our capital providers. The IRR is the total rate of return of the project, and it's another way of talking about the NPV. It looks like the rate of return of the project is greater than the discount rate, therefore the NPV must be greater than zero. So let's go back to our presentation. Let's going to modify a little bit. Well, actually, before I do that, I want to talk a little bit about free cash flows, taxes, residuals, and depreciation. Mentioned in the last topic, many companies actually have two financial books, and that's not illegal because you're allowed to have one for reporting and one for tax. There are two different rules that govern the reporting of financial statements in 10K and 10Q. That's governed by FASB. Versus rules that are governed by the federal government that determine what your tax rate is. So, for example, under FASB, you depreciate the difference between the cost of the CapEx and the salvage. However, under the federal tax system, you depreciate the full CapEx. So that difference, so it's going to be a different way of calculating depreciation expense. What I'm going to tell you is, for our purposes as finance professionals, or anyone trying to make a financial decision, you're going to go with the tax methodology, because the tax methodology are going to have implications on cash, and that's what we're after. Now, whether we use FASB or we use the depreciation of CapEx and taxes, it doesn't matter. We're still going to wind up using our after-tax residual value of equal to the salvage minus tax on the difference between salvage and accumulated depreciation, or net book. The only difference is I want to make sure I use the tax required depreciation to calculate accumulated depreciation. So we can just go and take our model and just plug in a few different numbers here. So let's actually pretend that at the end of 8 years, it's not worth 800, it's worth, say, 300 on the machine's salvage value. So at the end of 8 years, you're going to sell it for $300. Notice these cash flows are all the same. However, that last cash flow, I want to pick up a salvage value. And that salvage value is 180. Now, where did I get that? I took my salvage value, $300. I calculated the accumulated depreciation by the end of the 8th year, which is just 8 times my $100. Then I calculate the net book value. The net book value is the $800 cost minus the $800 accumulated depreciation. So it has a net book value, or book value, of 0. Therefore, the tax is going to be 300 minus the tax rate times 300 minus 0. So in other words, we're taxed on the full 300. According to the IRS, the asset you just sold had no cost basis, or a 0 cost basis. Therefore, you're taxed on the full 300, and that means you only get to keep 180. Now, what happens if it's only worth, say, 50? You can see there your salvage is 50. Again, it had a 0 cost basis, so you only get to keep 50 minus the taxes on the 50. But let's do something different. Let's say that in the model, the IRS requires this type of machinery to be depreciated over 8 years. However, you determine that you only want your model to last 7 years. Now, your business to last 7 years. So we're going to make a change here. Even though we're going to depreciate this on an 8-year schedule, at the end of 7th year, let's go ahead and sell the equipment at $50, a new assumption, and we'll calculate the cash flows and NPV. So let's go ahead and do that. Let's change this little word here. Let's go, so salvage in year 7 is $50. The cumulative or accumulated depreciation is only going to be $700. So at the end of year 7, that asset has a net book value of $100. In other words, you bought it for $800, you depreciate at $700, has a net book value of $100. So my after-tax salvage is going to be $50 minus the tax on the difference between 50 and 100. Now, what's interesting about this case is the net book is 100 and the salvage is 50. So according to the IRS, you're losing $50. So the after-tax salvage is actually greater than the salvage because you're going to get a tax shield on the $50 loss according to the IRS. Therefore, it's kind of a strange situation that the after-tax salvage is greater because you get to show a loss, which then shields the rest of the corporation from profits of 50, which saves $20 in tax. Notice our NPV and IRR are still calculated here. So let's talk about capital budgeting for cost-only decisions. When we do cost-only decisions, we can do a little shortcut. We don't have to generate a full income statement and get sales and cost of goods sold and all that kind of stuff and EBIT and add back depreciation. If we just have a cost-only project, we can just subtract out the after-tax operating cost, which you can just say is the cost times 1 minus the tax rate. And if you were to, that cost reduction project involved the purchase of capital equipment, the cash flow associated with capital equipment would be the depreciation expense times tax. So let's go ahead and do this little example here of this copier. So in this example, we are either going to fix a broken copier or sell the copier and outsource. All right, both of these are going to involve costs. So what one we're going to do, we're going to do the one with the highest NPV. Now these costs, the NPVs are going to be negative, so you're just going to choose the one with the lowest negative NPV, the lowest negative or net lowest cost, NPV of cost. So let's go ahead and calculate if we fix the copier. All right, if we fix this copier, we're going to pay $17,000 today to fix the copier. However, that expense is going to create a tax shield. So we're actually going to pay after tax $10,200. And if we fix the copier, well, then we're going to keep using the copier. Our in-house copying expenses are $25,000 a year. That's going to create a tax shield, so I'm going to pay 1 minus the tax rate, $15,500. However, if we keep the current copier will continue to depreciate $3,000 a year. That $3,000 non-cash expense is going to create a tax shield of $3,000 times the tax rate. So if I fix the copier, it's going to cost me $10,200 today after tax. If I keep it, I'm going to spend my $25,000 after tax is less than that, but I'm going to get a tax shield from continuing to depreciate the asset. And those cash flows will continue. Those cash flows will continue. And I can calculate the NPV of this cost. Take the NPV, put in my discount rate, I'm going to anchor that, comma, put in my future cash flows, and then add the first cash flow. So there my NPV is negative $59,945, but we need a copier. Now the only question is, what if we just what if we sell that copier? I'm going to hide this column now. What if we sell the copier and outsource copying to another firm? Well, if we sell the copier today, we are going to get, and here's an estimate of that cost, we're going to get $5,000 for our used copier. However, we're going to see what the tax bill is. So I'm going to subtract out the tax rate times the difference between my salvage of $5,000 minus the net book, and which is assumed that your accountant told you it's $15,000. So what's this going to do? We're going to get $5,000 minus the taxes on $5,000, but that's not really true because according to the IRS and your accountants, that asset you're selling for $5,000 is worth $15,000. So according to the IRS, you are taking a loss of $10,000 for selling the copier. Therefore, the after-tax cash flow is actually greater. It's $9,000. So my after-tax cash flow from selling the copier is $5,000 plus a $4,000 tax shield. And now let's get the outsourcing expense. So if I get rid of my copier, I'm going to have to pay a firm to do all my copying. So that expense is supposed to be $33,000 times 1 minus my tax rate. So my outsourced expenses are $19,800. I'm just going to put a link there. Right? So in this case, my outsourced expenses here include, say, if I kept it in-house, I only pay $25,000. So that would be, say, the cost of ink and paper. And if I outsource it, I'm going to pay $33,000. So it looks like my outsourcing firm might be making a few dollars there. I can then calculate the NPV, and it looks like, well, let's take a look at my NPV, make sure I've anchored everything. Nope, I didn't anchor my discount rate. So let me anchor that and then copy the NPV. And that has an NPV of cost of $62,000. So I am clearly going to fix the copier, continue to depreciate, and keep it in-house. I'm going to save $2,000 in present value terms. So let's do another one, corporate buy versus lease. You're going to buy a computer and either purchase it for $4,000 and depreciate it over 3 years with no residual, or I'll do an operating lease. In the terms of the operating lease, I'm going to pay $1,500 today and then $1,500 at the end of year 1, 2, and 3. And that's how leases are often structured, with the first payment happen today. So let's go ahead and do our lease. So if I buy a computer, I'm going to pay the CapEx. That's today's cash flow. Now, the only future cash flow is the depreciation tax shield. The purchase cost is $4,000. I'm going to divide that by a depreciable life of 3 years. That gives me depreciation expense of $1,300 a year, and multiply that whole thing by the tax rate of 40%. So that's going to create a tax shield of $533. So I'll just copy that. So those are all my cash flows associated with purchasing and depreciating. I can calculate a quick NPV, put in my discount rate. I'm going to anchor that for sure this time, comma, the future cash flows, and add back the initial cash flow. There's my NPV. Whoops, looks like I used the wrong discount rate. Let's make that 9% and not 40%. There we go. $2,649. Now let's talk about if we lease it. I'm going to hide this column. If we were to lease this asset, I would pay a lease operating expense of $15,000 this year. That's going to create a tax shield. So after tax, that is only going to be $900. I'll pay that at the today and then the next 3 years. And there's my NPV of leasing it. So what it looks like is I am going to purchase it and depreciate it and not lease it. I can calculate the NPV of the difference. You can see there the NPV of the difference, and that just shows me the NPV of the difference. I could just subtract these numbers, take the difference here. So you can either just take two NPVs and take the difference of them, or take the NPV of the difference. So it looks like choosing the purchase over the lease will actually create a positive NPV project of 528. In other words, just that decision to purchase over the lease creates a value of 528. So here's an interesting one that this is a situation where NPV actually doesn't work. I could either buy this cheap light bulb right here that lasts 4 months, or I can buy this expensive fluorescent light bulb that lasts 40 months, and I've estimated the actual cash flows. Say that cheap incandescent light bulb costs $1 today, $2.50 per month in electricity, because they're much higher wattage, and only lasts 4 months. Or I can buy that expensive fluorescent light bulb that costs $5 today, only costs 38 cents a month to operate, but lasts for 40 months. Let's assume that our after-tax cost of debt, since this is maybe a risk-free investment, switching from one light bulb to another, is 8%. Say it's close to a risk-free rate. And let's calculate the NPV and show you it doesn't work, and show you how what we're going to do about it. So I'm going to go to my EAC, and I have some data here. On the next slide, you'll see here's some estimates I got from the textbook that talks about how many hours per month you're expected to use it, and lifetime of the bulb, and the monthly cost in electricity based on the price of kilowatt hours. But you don't need to know that. All you need to know is that light bulb cost $1 today, that cheap light bulb, and $2.50 to operate for 4 months. And my NPV of that cost at a discount rate of 8% is the NPV of that 4-month light bulb is $10.84. Now the fluorescent one cost me $5 today and only 38 cents a month to operate, but it lasts for 40 months. When I calculate the NPV of that 40-month annuity plus the $5 today, that NPV is actually $18. So it looks like I should choose the incandescent light bulb, but it only lasts 1/10 of the time as this one. So here's what we're going to do. This is called equivalent annual cost, even though that should be equivalent monthly cost. In this case, I'm going to calculate a payment. In other words, if I create a payment over the life of this light bulb is a 4-month light, where the present value of the cost is the NPV, $10.84, it creates a level payment of $275. In other words, a level payment of $275 at 8% per year. In other words, by the way, I had to divide that by 12 to get to a monthly rate. The monthly payment of $275 a month for 4 months has the same present value as $10.84 today. And if I calculate the payment of a 40-month present value, that gives me a payment of 52 cents a month for 40 months is equivalent to a present value of $18. And here's where you see is it's clearly better to buy the expensive fluorescent light bulb. It operates on a monthly basis at 52 cents, even including the $5 cost. And then that cheap light bulb operates at $275 a month. So if you have projects on unequal life, calculate effective annual cost, converting the NPV into a monthly pay, or to over a payment based on the cost. And again, there's just some details of how I got to the 271 or to the cost. Now, so 2 other things we want to do is, one, we're going to talk about the choice of accelerated or depreciated or accelerated depreciation or straight line, and at the same time talk about how to do the NPV of a cost-saving projects. So a project that only is expected to save cost. So here's the project. By the way, I used some name ranges in here. I named this cell CapEx, this cell life, annual savings, salvage, tax rate, and discount rate. So I'm going to buy a machine today that's going to save me $3,000 a year for 6 years, the life of the machine. At the end of the 6 years, I'm going to sell the machine at $4,000. Well, actually, we're gonna assume that we sell at the end of 5 years. We'll make it a little more interesting. We're going to depreciate the machine over 6 years, but at the end of year 5, we're going to sell it. And so we're going to do 2 things. We're going to calculate the present value, assuming straight line, and then assuming acres. So we're going to decide first, do we want to do it? And if we want to do it, do we want to do straight line or acres? Now, acres is just a depreciation method. A straight line depreciation over 6 years says take 1/6 of the cost and recognize as a depreciation expense every year. So notice over here, I would take, in a straight line depreciation, I would take the CapEx divided by 8. And what that is actually 16.67% annual depreciation of the cost. If I multiply that depreciation by the tax rate, that's going to be my annual tax shield. So let's continue on and calculate the NPV of this project, assuming a straight line depreciation. If I do a straight line depreciation, looking down here now, I'm going to, well, let's go a little bit farther. Straight line depreciation, I'm going to buy the equipment for $10,000 today. I'm then going to have the tax shield right here. This is the tax shield of my 666. That's going to show up as a positive cash flow of 666 right here. That's F10 right there, and that's going to slide down to F11. In addition, we're going to treat cost savings as a revenue, right? The absence of a cost as a revenue, a reduction of a cost as a revenue. So I'm going to add the savings and multiply times 1 minus tax and get the after-tax savings. So if I take the after-tax savings of buying this equipment plus the depreciation tax shield, that's going to be my annual savings using straight line. And then I just have a formula here. At the end of year 5, I looked at my accumulated depreciation, got my net book value, and there is my after-tax salvage. I'm going to add that to the last cash flow. So I clearly want to buy this machine. it has an NPV of 2682. Now the only question is, should I use, if I had the choice, could I use an accelerated cost recovery system? In other words, a depreciation schedule in which they're unequal, in which the recovery, the annual recovery, is faster than straight line. In other words, again, straight line said it's 1/6 every year, 16%. Here's an accelerated system, which you'll be given. These are given by statute, right, by FASB or IRS. So here's the 6-year accelerated program or system, 20% the first year, 32, 19. So notice all three of these are above 16%, so it's accelerated. And then less than 16. Notice all these will add up to 100%. So if I use these tax shields each year, these depreciation percents this year, my annual depreciation is going to be that percent times the CapEx, which gives me these tax shields. And if I just take my original problem and use these tax shields instead, I wind up with these cash flows. And then I also add back my after-tax salvage, which is different because I have a different depreciation schedule. And it looks like, yes, I want to do the project. It's going to save money. However, if I use an accelerated depreciation, I will have a higher NPV. So yes, I'll do it, and yes, I'll do an accelerated depreciation. And you can actually figure out that any time you have the chance to do an accelerated depreciation, you should always do it. It has to have a higher net present value. Because no matter if you use accelerated or straight line, it's the same depreciation tax shield spread over the 5 years in this case. However, with time value of money, this one's going to front load the benefit. So let's talk about our last topic, and that is, according to finance theory, the only two measures I want to look at are NPV and IRR. And if I had to choose one, I choose NPV because I care about cash. However, many corporations use something called a payback and a discounted payback. That's just two other measures to look at a project. So let's look at this project, Project A. We're going to have cash flows of $500 this year. In present value terms, that's $500. It's going to generate $200, $100, and so on. And the present value of those cash flows are there. If I sum up the present value of all cash flows, it gives me an NPV of 133. If I take an IRR of this row here, or column here, I get an IRR of 17%. Now what we're going to do is calculate something called the payback period. So let's go back. The payback period is literally how many years does it take to pay off the initial investment if that initial investment was zero. So let's do a cumulative cash flow. All right, so I'm not going to use this one. I'm going to use this one. The cumulative cash flow, non-discounted, in the first year is 500. In the second year, I already spent 500, but let me add to it my cash flow in year 2. So I'm still down 300. In other words, I haven't paid off my $300 yet. And then I can copy that formula down. In other words, looking above and getting the new cash flow. So at the end of year 1, it's still not paid off. The end of year 2, not paid off. The end of year 3, not paid off. By the end of year 4, it is paid off. So what is the payback period? It's somewhere between 3 and 4. So I'm going to write down the payback is equal to 3. And then I'm going to take my negative balance I started at the end of year 3. I'm going to subtract that to make a positive number and divide by the cash flow in year 4. And what that tells me is on average, it's going to take me about 3.5 years. Assuming this $100 is spread evenly, it's going to take me half a year to pay off $50. So the payback period is 3.5. Now the only other number we can do is a discounted payback. Do the same thing. Start off 500 in the hole. 500, add the present value of the first cash flow. And just keep adding it down. So at the end of year 1, it's not paid off. Year 2, it's not paid off. Year 3, not paid off. Year 4, not paid off. Year 5, it's paid off. So somewhere between year 4 and 5, this project turns positive. So what we can say, it's going to be equal to 4. And then I'll just take change the sign of this balance, divided by 250, that's, I'm sorry, 170, which is the cash flow, discounted cash flow in year 5. So it's going to take me 4.21 years to pay it off. That makes sense because we enter with this small balance of negative 36. I'm going to make 170 in present value terms in year 5. Therefore, it's only going to take me, say, a couple months to actually pay off this amount. So that's payoff or payback and discounted payback. So I have a project B here. I already made the calculations. So we now have this discussion here about if you wound up getting these values, project A, project B. Project A has the higher NPV. Project B has the higher IRR. Project B has a faster payback and a faster discounted payback. So it looks like this has a lot going for it. So the question is, do you select project A or project B if they're mutually exclusive? Mutually exclusive means you can't do both. Now, if I could do both, I would accept both of them in a minute. Positive NPVs, IRRs greater than a hurdle rate. I would accept them both. If I can't do one, the one I'm going to pick is A. Let's go back to our first principle in finance. Cash is king. Cash is what's matter. For a firm to maximize value, they don't maximize rates of return. They try to maximize cash. So I'll choose one. However, I'll give you one little caveat. If these projects were scalable, in other words, what if I could do project B 5 times? Well, if I can do project B 5 times, it would have the same cost as project A and have 5 times the NPV. So that would be probably closer to 200. So if this were scalable, I could do multiple of them. I would choose 5 project Bs versus project A. But assuming they're not scalable, I'm just going to go with the highest NPV and go with project A. So in this topic, we talked about capital budgeting. Capital budgeting is a process of valuing and selecting investments. We used NPV, IRR, payback, discounted payback. We looked at revenue-producing investments, cost reduction investments, lease versus buy decision of how to depreciate the CapEx, outsourcing decisions, and we dealt with the NPVs of projects of unequal lifespans. We talked about if the project has the same risk as the firm, use WACC as your discount rate or IRR hurdle rate. If it's risk-free, maybe use the after-tax cost of debt. Lastly, we talked about the one measure we should always use is NPV. One little caveat, if these projects almost had the same NPV, kind of close enough, I would probably then start maybe using these other methods as tiebreakers. So all else equal, I would like a project that pays back faster. However, if the NPV should rule.